Hey, you guys! Hey, what's going on, everybody? It's Thursday, February 20th, 2025. I, of course, am Hammer. Here's the Daily Mortgage Rate Update, the only place on the web where you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting to you on Facebook and on YouTube from the beautiful snow-covered Smoky Mountains. Here, check this out. I'm going to take you all for a little bit of a ride with me this morning. Come with me. We're going to take a look here. Look at this. It is absolutely gorgeous out there. The best part is that it will all be gone this afternoon. It's like an inch of snow, but it is just, look how beautiful that is out there. My wonderful winter wonderland. I do love it out there. So I love living here in the Smoky Mountains. But if you're here this morning, say good morning. If you are watching on the replay, go ahead and give me a hashtag replay in the comments. Let me know that you were here. Let Facebook and YouTube know that you were here. Don't forget to smash that like button, tag a friend, share this post in a group. And if you would like a reminder that I am going live, you can go ahead and sign up for that at hmmr.io/reminder. Is it just you and me, Randy? Oh, there's Megan Lindbergh, Taylor, Henry. Good morning. Now y'all are popping in. I don't have my number of people up here. It's bugging out again today, but that's okay. Hopefully the text message went out and things are going out well. Good morning, EJ McDonald. Glad to have you here as well. So let me go ahead and pop this off the screen. If you are here this morning, say good morning. And I got a question of the day for you today. This one is a little self-serving, though. Do you want help getting more business from social media? That is a question of the day. Let me know your answer to the question of the day in the comments. Good morning and top of the morning to you, Rob Stewart, Nathan Einkorn, live from the sauna. Dude, will your phone like blow up in a sauna? Did you do a cold bath and then a sauna? Are you doing like the Joe Rogan thing? Michael Love, good morning. Tim Klyler, great to see you. Venkat, good to have you here. Hey, y'all. So appreciate all of you being here. Let me know in the comments if you would like to get more business from social media. Again, a little bit self-serving. We are rolling out the new product over here at Hammer Solutions. I know many of you affiliate me and associate me with Originator Success. I've kind of built that as my lone brand in the mortgage business. This year, we're actually branching out. Originator Success is a product, not the company. The company is actually Hammer Solutions, and we're going to be sharing out some new products, one of which is Grab and Go Social. I'm going to be pushing that one out in a little while. So sauna first and then the cold plunge. Dude, that's hardcore. That is crazy hardcore. Good for you for doing that. I couldn't do that stuff. So, all right. Well, let me know in the comments if y'all are interested in getting more business from social media. I'll be talking more about that in a little bit. But in the meantime, let's go ahead. Let's jump in and get started again. Hello to all of my friends here this morning. Quick recap on what happened with rate sheets yesterday. Rate sheets actually improved a bit yesterday. Let me bring up the screen. I'll show you what happened and why. Here you go, my friends. So if we take a look here, let me bring this up so that it will come a little bit higher on the screen. There you go. Okay, so taking a look here, you could see yesterday we started out, pricing came out around 10 a.m. and we got a nice bump up through the day. Saw a little bit of a jump right here at 2 p.m. That was when the Fed meeting minutes came out. I'm going to tell you a little bit more about that in a second, but this was a really nice improvement. When we take a look after like a 5-day, we could see that we had lost some ground the previous few days and have since recovered, kind of flattened out to where we were back on Valentine's Day on February 14th, which was last Friday. So just lost some ground on Tuesday and Wednesday because of the holiday. So Tuesday, Wednesday, and pick that back up so that we're right here Thursday, right back where we started. And that's a nice thing to see. The reason that we saw this improvement and we saw the comments here were because of because of the Fed and some comments about the Fed meeting minute runoff. So, but let's keep going today. So rate sheets today are going to be better. rates still remain in a very tight range. We're not seeing much movement on this at all. Let me adjust this to the screen so we can look at this together. Hold on a minute. Come on. There we go. And let's pull this down a little bit. Come on. All right. So taking a look here, you could see mortgage bonds very much in a, straight line. Even though we go down, we come up, we go down, we come up, we go down, we come up. But really not moving much. And if you take a look at Mortgage News Daily, use that as a reference point, you can see that same behavior, right? 7.02, 6.96 being the low point right there. Last Friday, 7.04, 7.13. So really just holding steady right around that 7.125 mark for most of these loans. If we look at what's being locked and use Optimal Blue instead, we can see a little bit of a different story. Rates apparently are a little bit better here as what's being locked, but this could be because of points and stuff. I don't really know. But if we take a look here, you see a high of 6.9, 6.87. I'm not going to round. We're just going to go with the first two, 6.81, 6.80, 6.82. I mean, really, you're not seeing rates move much at all. So there's some day-to-day movement, but overall, there's not a lot of risk. We're not seeing rates creep higher. We're not seeing rates move lower. That's kind of where we are. So reprice risk is low today. There shouldn't be any really big moves to worry about. We got jobs data this morning, and that was about it. So let's talk a little bit about what's going on in the headlines, though, and what's affecting rates today. So let's see. We're going to go through this a little bit at a time. So first things first, Scott Bessent says the U.S. is a long way from boosting longer-term debt sales. What does that mean? Well, when we borrow money, what drives mortgage rates up is when mortgage-backed securities move lower, when they sell for less. When you see the 10-year Treasury yield move higher, that's bad for mortgage rates, right? That's bad for bonds. The reason that you see this move higher, one of the contributing factors can be supply and demand. Now, that's why yesterday, I'm going to jump around a little bit, but we're talking about kind of the same thing here, right? So yesterday, the Fed meeting minutes were talking about balance sheet runoff, and I'll come back to that. This morning, Scott Bessent says, hey, we're a long way from boosting longer-term Treasury. So what he's saying is that when we borrow money, which we borrow tremendous amounts of money in the U.S., when we borrow money, we're borrowing it on the shorter end of the yield curve on like 1-year bonds instead of, which are actually not bonds at that point. I think they're notes, is it? But it doesn't matter, right? So bottom line, they're not borrowing, they're not putting more 10-year supply, more 30-year supply in. And what this does is if there's less supply, then you don't need more demand. It helps the prices to move down, helps the yield to improve, okay? Because people are willing to pay more to get a longer-term bond. The risk to your longer-term bonds is going to be inflation, and it's going to be that supply. So what's happening is, it's funny because before he came into office, Bessent repeatedly criticized then Treasury Secretary Janet Yellen for boosting the share of bills, the short term, which mature in up to a year in U.S. debt, something he argued held down longer term yields and was done to boost the economy before the election, which it was. Now, of course, he criticized it because that's exactly what was being done, but it does do that. It does keep that long end down. And Bessent has said, hey, we want to bring rates down. Trump wants rates down. His job is to help make that happen. So he's continuing to do what Yellen was doing. So he's retained Yellen's plan for debt issuance, doing more of the short-term bills rather than the longer-term bonds. Now, asked about his past comments, he said, well, the previous administration shortened some of the duration. We haven't shortened it any further. So he kind of ducked, bob and weaved that one. We're still seeing sort of the Biden inflation that's still coming through. He said, as the market starts to realize what we're doing, if inflation starts to drop, and we'll see, it's going to be path dependent, he said, of stepping up longer term debt sales. That's the eventual goal, but I'm not going to signal it now. So in order to get a better interest rate, they can do that on these longer term bonds, right? So that's what they want to be issuing, but if they do that, it's going to drive up interest rates in the near term for what we see for everything else. So that's why they're not doing this. Now, the other thing Here's the other thing that's affecting it. So yesterday we did see mortgage-backed securities improve. Let's move this to the 2-day. We saw them improve right here and kind of improve through the rest of the afternoon. You see this uptick, and the reason that we saw that was because the Fed meeting minutes signaled officials on hold until inflation improves. But right here, the debt ceiling could prompt changes to balance sheet runoff. So this basically said that in the meeting minutes, the Fed came out and expressed that they're going to hold more, their policy rate where it is until they see signs that inflation is improving, or if we were to get a lot of weakness in the jobs market, right? Now, we could see weakness in the jobs market. Remember, there's a lot of things going on here. A lot of government employees being laid off. Now, are they going to go out and say that they're looking for jobs? Are we going to see an increase in that, participation rate? Are we going to see unemployment tick up because of these numbers of layoffs in the government sector? The government is the largest employer in the United States, right? So, are we going to see that? Is it enough to cause concern? Well, what about how does that counteract with the concerns in immigrants and the fact that there is talk that if we have a lot of people that are being deported out, there's jobs that are now opening up because these jobs are being filled by illegal and even legal immigrants that won't be going to work anymore. So maybe that creates more demand. So there's a lot of different variables that are coming into this. But when we look at this, what happened was the Fed came out and they dealt with talk of the debt ceiling showdown. And we don't talk about the debt ceiling. Used to be a really, really big deal when we would see the debt ceiling conversation. And now it's a lot less so. It seems like that they're always kicking the can down the road. They're always increasing the debt ceiling. Now, some officials expressed concern over risks posed by the potential for a debt ceiling showdown in Washington, regarding potential for significant swings in reserves over coming months related to debt ceiling dynamics. Various participants noted it may be appropriate to consider pausing or slowing balance sheet runoff. This is what traders were actually trading into yesterday. It's why we saw bonds improve. Now, this is only a short term. It's temporarily pausing or slowing balance sheet runoff until the resolution of the event. But any chance of balance sheet runoff that slowing down, bonds like that idea, it decreases supply, which it's not increased demand, but it will drive the prices up and drive the yields down. So the Fed is currently allowing up to $25 billion in treasuries, $35 billion in mortgage-backed securities to mature each month without reinvesting the return principal. Remember, quantitative easing, they bought all of this up during COVID. That's what kept rates so artificially low. Now they have been letting it fall back into the markets and back into the natural trading rhythms. And that's what we're seeing happen here. So these are all the things that are affecting your rates right now. The bottom line is that, things look pretty good for rates. There is room for rates to lower a little bit if momentum continues. But when we look at the technicals, there's quite a few things here that I would be looking at. Number one, mortgage-backed securities are currently they started the day above this 100-day moving average. I think there's a good chance that we're going to fall down here. So let me go ahead and I'm going to put the lock advice down at the bottom there. So lock advice, if it's less than 15 days, I'm closing. This may be a bit conservative, but I'm okay with that, right? So anything's closing in the next couple of weeks, I'd be locking it up. I think we're at a really good spot right now. Yesterday, we saw some improvement in pricing. If you didn't see reprices better yesterday, you saw better rate sheets this morning. But you look at this green line, look at the technicals here. There's not a lot going on in the fundamentals. We're going to get PCE inflation data next week, and that could help. But that's really the only big thing that we're looking at. And if you look, mortgage-backed securities have really struggled to break through or stay above this 25-day moving, or I'm sorry, this 100-day green line, 100-day moving average right here. And if we go back and we look at this, I'm going to show you a bigger one in a minute, but when we look here, we started this morning, we're above it. Now, arguably, when you start above it and it comes down, this is now a support level, but there's no confirmation. We didn't close above it. So there's a good chance, I think, that we see things kind of fall down. Right now, we're up 9 basis points. It's not bad, but again, for loans that have time, that have 15 to 30 plus days, I wouldn't be worried about locking them. We have minimal risk to floating right now. We see movement, back and forth, but when we look here and look at the pattern, we're not seeing rates go up to 7.5 and drop back down to 7. And we're seeing rates stay within 1/8 of a point. So there's not a lot of risk. There's nothing out there that says, hey, we're going to drive things up. But I would be looking at, probably locking anything closing near term. I think it's just better to lock those and be done with this risk based on what we've got going there. So that's my advice for this stuff. I think we're in a good spot here. I don't think that you really need to focus too much on that. What I wanted to show you, let me make this full screen and I will show you the here you go. Let's go ahead and take a look at that chart. If we look here, let's move this for 6 months and you will see, look here back in November and early December, we were unable to break above the 100-day moving average there. And then it fell much farther below it. We came back up. We've been testing it here, not really breaking above it. Now, if we go back for a full year, you can see that we did spend quite a bit of time and with mortgage bonds staying above that 100-day moving average. I mean, we're talking from, basically the middle of June, even the beginning of June. There was a little dip there in July, but above that 100-day moving average, falling back to test it here. And then since then, we've been below it. Now, remember, this is that September line right here. We were above it. Everything was great. And once we fell in October, since October, we have been below this 100-day moving average. You see it right here. Once we crossed below it, it has not been able to break above it and stay above it. We fell below it. We've tested it. We fell. We tested it. We fell. We're testing it. I don't think we're going to see mortgage-backed securities really get any momentum here. And that's why for the near term, I would be locking because it's more likely that we see some pullback rather than any improvement. Same thing with that 10-year treasury yield up here and we look at and all the technicals that are coming into play there. So Tom said, isn't this the opposite of what you were saying yesterday? I don't see rates improving. Hold on, let me put that up on the chat so you can actually see it. I don't think so, Tom. I'm still staying with that same thing that I said. I'm showing you right now that based on this, I don't really see things that are out 15 to 30 plus days, keeping your options open on those because there's not a lot of risk that rates are moving higher is why you can go ahead and leave those. You get better lock windows, so you get better pricing with a shorter lock window, that kind of a thing. But I still don't see rates really moving that much better from here. Again, you're always going to see some day to day. We don't stay exactly the same on any given time. But even when we see here, look at where we're at. I mean, we're still very much 7 is the median. It's kind of where we stand. So no rates. I don't see rates improving. It's not different than what I said yesterday. At least I don't think it is. And in fact, yesterday I said lock anything closing in the next 15 days. Did things improve yesterday? Yeah, they did. We saw a little bit of momentum, like I pointed out, we saw some momentum from the Fed meeting minutes in the afternoon. Like pricing came out around 10 and we were at 100.73, right? 100.70-ish. And it stayed that way. There was really no movement until 2 p.m. You can see we were exactly the same. And then as we got to the end of the day, we closed about 10 basis points to 12 basis points higher. So there was some improvement. And again, I pointed out why we saw that. It was due to the Fed minutes and what was being said there, and the fact that there was talk of balance sheet runoff and pausing that. So that kind of helped things, but is it enough to really get super excited about? No, not at all. So any other questions? Oh, disregard, need to switch from the Irish coffee. Okay, good. Yeah, so we're all right, good. So yeah, I mean, and I always want you to call me out on stuff because I'll tell you when I have things change. So all right, my friends, I am going to go ahead and throw something totally different up there. I am jumping subjects. So this is available to y'all. This is the first place that I'm making this out live. So here's the deal. We're ready for Grab and Go Social. We got delayed a little bit when you're rolling out new products. It can definitely be frustrating. Austin got really sick. It was out for an entire week. But I'm going to throw this QR code and link up on the screen. And in the chat, I'm going to go ahead and post a link. This is not to a sales page. This is to a sign-up offer. So you can click this link and it'll take you directly there. So This is a pre-sale. I'm doing something different, doing something a little unique this time around. So this is a pre-sale. What I'm doing is giving you the opportunity to get in early, lock in discounts, and just jump right in with both feet. So it's $7 to go ahead and get in early. Let me post this here. So here is the sign up page. Let me make it fit the screen here. Okay, so here is your sign up page. This is only available through Friday. So it's today and tomorrow, and then it's closing. You can go ahead and sign up. So what is Grab and Go Social? Grab and Go Social is, it's 3 C's. It's content, coaching, and community. It's $147 a month. However, if you want to sign up during the pre-sale, and you guys go ahead and sign up here for $7, you're getting in early. So for $7, you're getting in before we roll it out. We're going to roll it out in March. You will go ahead. You're not going to get the full experience because we're still fine tuning it. Okay. But for $7, you're going to get in. And what you're going to do is, being an early adopter and getting in on the pre-sale, we're going to give you awesome pricing for the rest of the program. So if you jump in and give $7 today, and you get in, it's one $7 payment, and then your next 6 months, you're at $67 a month. Now this is going to be rolling out. It's $147 a month. And so you're getting it for $67 a month for 6 months. So you'll be saving, what is that? $80 a month for the 6 months. And then you'll lock in a discount of $97 a month for, as you know, we haven't raised prices on stuff even with inflation and everything. So you'll lock in and you'll save that $50 a month off of the full price for your, the rest of the time. So if you want to get in, and this is basically a, hey, do you trust Hammer? Do you want to get in early? Do you want to see? We're only opening this up for 2 days. We're only opening it up to about 100 people. And it's so that we can get some people into the program and finish fine tuning it and make sure it's rolling out properly. So if you are a fan of mine and you want help with social, now here's the background on this. You are going to get content, like that's what this is. Every month we're going to roll out a, can I make this smaller? All right, let me get rid of my head for a minute so you guys can see this clearly, right? So let me make this full screen so you can get it. All right. Every month you're going to get a content guide with everything that we're going on. Here's some ChatGPT prompts and different ideas for things you can post. You'll get a social posting calendar. And then, like, let's say you're going to post this meme. Remember, this is Grab and Go Social. This is why I said he hasn't finished all of it yet. So let me go back to here, and I picked a bad one. Let me see if I picked this one. But all right. So I think he's got something broken on it with this. So anyway, you'll be able to click that. You'll get that content. So you'll have a whole calendar that we create for you with content that you can go ahead and post. You can go ahead and recreate different content that we've got going on, platform specific. So like, notice these are for Instagram. This is for YouTube, right? So we've got all of this stuff. You grab it and go for this price. And if you click here, it's going to give you the Canva template that you can go ahead and use. So you're going to have pre-made content. You're going to have next level stuff, content that you can go ahead and do some stuff with. And then you're going to have coaching every week to help you to implement and get even more out of social. So if you're just looking for something that you can grab and go, that's why we called it Grab and Go Social. This will give you something. The key to being on social is consistency. It's showing up. That's the key. Whether you're on Facebook, Instagram, TikTok, YouTube, we've got access to all, we've got backgrounds in all these. This is a pivot and a recreation of our program Ignite. We've been doing this for years. We've been helping originators for years, but we want something that reflected more of what we're doing, where we're creating content, giving you things to run with. So if people sign up for this, you guys signing up are the first one. So if something's broken, I'll know after you sign up and I'll get it fixed. But what should happen is if you go ahead and you sign up, again, it's $7 that's going to lock you in for the first month. And then it'll go to $67 for 6 months. You can cancel anytime if it's not right, if you don't like it, if it's not any good, you can cancel anytime. We don't want to lock you into anything. And then if you stick with it and it's getting you business, it'll bump up to 97, but you'll stay discounted at 97 for the entire time. All right. and then the stuff that's going on there. But Robert, is this already done with OS? No, Robert, this is next level. So when we post things for you with Originator Success, we're posting the weekly rate forecast and some kind of social content for you. But if you really want to get business from social, you have to actively involve yourself. There's what we're posting is for localized SEO. It's to help you to win loans when people are researching you and Googling you. What Grab and Go Social is, this is you active. So that's a passive, some stuff for you, but passive social media isn't going to get you a lot of business. For example, have you gotten a bunch of business from your Facebook business page, right? Probably not. It's important to have, but it's not active. What this is if you want to be more involved in your social, you're looking for content that you can post through the week, content that you can post daily consistently, that you're actively involved in. Same things like we can post on your Facebook business page, but we can't post on TikTok for you. Posting on Instagram and building an audience and getting business, if generating real estate agent contacts, things like that, a more active participation. That's what Grab and Go Social is about. That's what this is all about. This is about helping you, weekly coaching. We're going to bring in outside speakers to talk about things. As much as I make fun of AI, there is some use to it. We'll be bringing in people talking about AI, talking about different things that they're doing. So that's what this program is. I'm doing a very poor job of selling it because this is the beginning, right? We haven't written any sales copy. This is just me sharing with y'all and giving you guys an opportunity to jump in on a pre-sale. By showing early support, you'll be getting discounted pricing, and you'll also be helping us to kind of fine tune. And we want to hear your feedback. We want to hear what's working, what's not working. What do you like? What don't you like? So we can fine tune it and improve the product. And then we're going to launch it in March. The launch date is March 17th. So it's a little less than a month away. So you're getting in early. You're getting in with, we do have March content available. This is all the full thing, but we're going to be fine tuning and it's going to be adjusting and improving. This is what we call minimum viable product, right? We want to roll out there by giving people, value, and then we want to build on that value. My thing is, we've seen the people that are working on social getting loans. I know Rebecca Richardson, Ariel Best, Nate Joma. I know these are all people that are, Cash Knees, Rebecca Foot, that are getting business from building and being on social. And we want to bring that to more originators, that you can do that in your market and in your sphere, and that you can get business, but it has to be affordable. I've seen too many programs where they're just flat out asking for a lot of money for coaching. And I don't want to take anything away from coaching, but it doesn't have to be that expensive, right? This is something we can scale with. So this is it's a 3-part process. Let me put on, this is the sales page, but I haven't really fine-tuned it yet. So, basically, let me just tweak this down so you guys can see it a little bit. And if you did sign up, let me know in the comments. Like Tim Klyla said, he signed up. Let me know if y'all signed up. Again, it's only $7 to get in, and you lock in your place in the pre-sale. You'll lock in the savings, $67 for 6 months, and then it'll go to $97 after that. We will be giving Originator Success members additional discount, but that'll happen later. So, but anyway, you're going to get content. So we've got that full content, calendar and library and everything that you will be getting. That's got all this stuff already in there. We're also going to be giving a lot more stuff. You will join the Facebook group where we've got, different things going on. Austin's always in there talking about what's working and giving ideas, helping you to generate more business. You're going to go ahead, and we've got a weekly coaching Zoom that we do every Tuesday at 3 p.m. Eastern time. He then posts those in the Facebook group. So you'll have that whole library. There's quite a bit going on there. So Ron, looking forward to having you, my friend. Tom Stafford, great to have you. Dan Crowley, thank you, sir. Alicia, thank you. Appreciate you too. Tim Klyla, great to have you. So, all right, my friends. Well, that's it. And thank you for your faith. It's important to me that we give you guys something. I think 2025 is going to be the kind of year that you've really got to have your stuff together. And it's activity. It's being in front of more people this year. I think there's opportunity to make money this year. I really do. But I think you've got to be out there in front of more people. I think social is just such an amazing way to do it. Even for, like, say, Originator Success, Austin did recently some content about Google and Google business profiles, and that leads to people signing up for demos and signing up for Originator Success. I can tell you that when in any industry, whether you're an originator, whether it's us, if we are out there on social, it generates business. Facebook, Instagram, YouTube. You're watching me here live, and all of that. So it's consistency and show up. That's what this product is for you. Candido, great to have you, sir. Appreciate you. All right, my friends. It's 10 o'clock. I've been babbling for a long time, and appreciate you. So y'all have a fantastic day, and I will see you tomorrow. Bye-bye.